welcome to the Build and Exit podcast. I'm Julie Wilkinson and I'm the host. And I'm excited today to have Erin O'Leary on the podcast with us. So I started the podcast off the back of the work we do in Wilkinson's, Wilkinson Accounting Solutions, because I realised, especially in the UK, but obviously it's worldwide, there is a gap and need for support in business growth, exit planning and acquisitions. So hi, Erin. Thanks for coming on.
Hi, Julie. Thanks for having me.
You're welcome. So a bit of background about Erin and why I've invited her on the show. So Erin is an M&A and exit advisor. She is the founder and CEO of Pegasus Capital, sort of started careers in fractional CEO work and has helped hundreds of businesses grow and acquire, exit, and with 30 exits in her current role. So bringing a lot of expertise to the table, even though you're across the pond, it's all it's all the same, but loads of expertise. And also really nice to see another woman in it doing well in M&A, which I think is, I don't know what it's like in the US, but in the UK, it is more male orientated. So I think it's going to be a great discussion. So first of all, Erin, I just want to hand over to you so you can say a bit about yourself and why you wanted to come on the podcast.
Absolutely. Well, first of all, I'd like to say thank you for your body of work. I've listened to your podcast and I follow you on LinkedIn. And I think that there are two parts to this business. I'm in the transaction part, you're in the advisory part, but overall, people understanding the ecosystem is incredibly important. And I think you put so much great content out there. And, I try to do the same, demystifying the process, helping business owners be successful. And that's so important. But my little blurb or elevator pitch is that I started at a very young age, knocking on doors and building relationships with business owners in my small town outside of Boston, Massachusetts. And then I leveraged that entrepreneurial experience to help business owners navigate the complexities of M&A transactions. So now with a proven track record in the lower middle market, I leverage my deep experience with business owners, and I've helped many people through transactions, most of them founder-led organizations, closely held businesses across multiple countries. And I love what I do. So please ask any question whatsoever. Nothing is off the table. It's great to be here.
No, thanks for the summary. And I know we've got you got one particular deal we're going to launch into, which is a 120-year-old business. I think I was right in what we were talking about that you were working on. But before we delve into that, in terms of, in your opinion, when you see the exits and the acquisitions, because I know you have seen it from both sides like we have as well, what do you think is the biggest issue that people find in acquisitions? What do you think your findings are?
In acquisitions, like on the buyer side, I would say, the statistics will tell you that over 90% of business owners have unrealistic expectations of value. So I think that is the overarching issue that we run into, because business owners think that they're building a business that is transitional, that they can actually sell and retire, only to get to that point in their life that maybe they didn't realize what the levers were to value. They don't understand what they have. And then they're either not able to make a transaction happen, or, they have too much, too late kind of thing, where they have advisors or people that have been working with them, and maybe they don't understand the levers to value when you're bringing a business to market. So I would say that's the number one thing. And again, that's not to, be tooting your horn too much, but that's why I love working with people like you that actually help business owners understand what are the levers to value, what does their cash flow look like, and is this business transitional? Can you actually transfer this business to a new owner and allow it to stand on its own 2 feet?
And I don't know, because I know there's a lot of talk in the market about brokers and valuations. So if in what you do, what are you sort of classed as? Would people class you as a broker, or do you help people find deals, or are you what's your sort of role in the process?
I broadly say I'm an M&A advisor, but I am a broker. I primarily help people on the sell side of the transaction. But as we were talking off camera, I do a lot of speaking. I do a lot of paid speaking. I do speaking to a lot of universities for students that are looking to do the ETA, entrepreneurship through acquisition, and, either independent searches or, strategic buyers, whatever they are. I try to help both sides of the deal table, because I do think that the best deals are when both sides are, in their sweet spot.
Yeah. And I don't know, this is my viewpoint, what I hear. So there's a lot of bad rep, really, for some brokers. I don't know so much about the US, but in the UK specifically, where people say they're overvaluing deals. My view, first of all, I think it's a bit of a blame culture, because if sellers were really ready to sell, they wouldn't actually need a broker to value them in the first place, because theoretically, the seller should already know the profits, the balance, the assets, and the value of their business if they had the right financial support. What happens in the UK is they go to brokers, and we work with some brokers. There are some ethical brokers, and there probably are some unethical, but some of these brokers in the UK are taking like large sums of money from people and then basically telling them what they want to hear, I suppose, or your business is worth this, because really the seller doesn't actually know. But I would say what's interesting is from the buy side. So buyers often, there's a lot of complaining that goes on about how bad brokers are. But in the end, if the buy side has a good financial team helping them, why does it even matter? Because surely you'd get to that understanding relatively quickly. So even if you get deals and then the seller's overvalue, you just walk away, don't you, and move on to the next one. So I actually wonder whether there's some lack of financial expertise on both sides, which is why buyers can waste a lot of time and value meaning time and their, not always money, but maybe their time as well on deals when actually the deal never comes to anything, but perhaps they haven't got the right expertise from the beginning either.
Yeah. And you're absolutely right. There's just hopefully it's not too much of a complaining culture, but there is a lot of, finger pointing and things like that, because in my experience, some brokers will put anything on the market, and that doesn't look good for us, as a profession, because, maybe they're putting a ridiculous price tag on something. What I try to do is, if my seller is reasonable, but we're not quite on the same page in terms of price, maybe we'll market it without a price and then provide the background on how we came up with the EBITDA and allow the potential buyer to come up with their own formula. And I find that is a nice way for the market to speak, where the seller is like at least understanding, like, I came up with maybe my valuation, which was X. You came up with yours that is Z. I'd love for you to get that. Well, that's the nice thing about working with a broker or an M&A advisor, is that they are aligned with you and wanting you to sell at the best price possible. But it's also sometimes I've found that it's also can be the CPA or the bookkeeper that also inflates the value to a seller, because they're maybe not looking at, eliminating depreciated assets off the balance sheet, or they're, looking at the valuation in a different way. At the end of the day, it's the market that comes up with the valuation.
Oh yeah. And that wouldn't surprise me. In the UK, you don't actually have to be qualified to be an accountant by law. All you have to have by law is money laundering. So I do think it's something that people can go into when they maybe not as experienced as they should be or as qualified as they should be. But yeah, I have seen it, and it's not so much. I don't know whether they intentionally overinflate, but from our experience, because we do a lot of consultancy with people, especially through the acquisition. So we're not always their accountant, but we will see their accounts through consultancy or through exit analysis. And we generally, what we tend to find is there's a gap between the bookkeeper and the accountant, because the accountant, if the accountant isn't the bookkeeper, which sometimes they are, but often they're not, and people either have in-house bookkeepers or outsourced, there's then a gap between, so the accountant will get the trial balance for the year end, so like the balance sheet and profit and loss, and they will just have expected that whoever's doing the bookkeeping will have reconciled that business. So meaning that the integrity of the accounts is upheld, because really the accountant's job is to calculate the tax.
Exactly.
Which is a different job. And that's what a lot of business owners, I think, don't realise, because they'll just go, oh, I love my accountant, they're brilliant. And yeah, they might be perfect for what they're doing, but is anybody actually looking at that gap between what the bookkeeper's doing? So then if you haven't really got a qualified bookkeeper or some form of financial expert driving the bookkeeping, so perhaps the bookkeeper can be more junior, but you should have some form of more senior person overseeing it, then obviously if what you give to the accountant at the year end is already wrong, then it doesn't matter how good they are, the taxes are wrong anyway. And then that's where it all spirals, because then it can go through years of these issues. And then, that's where then the balance sheet gets built up with inaccuracies and all goes downhill from there, really.
Yeah. No, exactly. I mean, and that's exactly what I've come across, is that accountants are typically good at compliance. They know how to tie the income into the general ledger and, potentially fill out the box on a tax return. But also in the US, you don't necessarily have to have a qualification to be a bookkeeper, and it's garbage in, garbage out. And they're typically also not finance experts, which is a totally different thing when it comes to modeling and forecasting. They just, some of them don't even know what a pro forma is. And that's okay, because that's not, they know things that I don't know. But at the same time, I think that a lot of business owners will rely too heavily on these people because they've worked with them year in, year out. And if that advisor isn't willing to kind of be open-minded, they tend to have a closed, thought process on their sale process. And I think that's where, I find myself oftentimes is I enjoy working with founders and owners who they know their business very well. I love working with the ones that know their KPIs and they know their ratios and they're very on top of it. But even if they don't, if they at least have good advisors, and then I can represent them well to more sophisticated buyers, because if they've built and grown a business that's big enough for a financial investor to buy, then that's going to be the next hurdle. Because if they don't have defendable values, then you end up just struggling in terms of negotiation.
Yeah. And the biggest problem I see is I just think founders are generally not financially literate enough. And it is a hard one because they're not meant to be, they don't need to study for 8 years to become financially literate. But what I mean by that is no advisor is with you 24 hours a day. And I've even seen businesses that have had full-time CFOs being paid a lot of money even when you get into the crux of those accounts, there's still issues in them. And sometimes, and that's mainly because they go off to get a CFO who's very strategic, but they still haven't invested in the back office team, and nobody's leading the back office team. So like you say, garbage in, garbage out. Even the CFO, if they get garbage out, they're using garbage to steer the business, and they might not know because maybe they're fractional and they're only there 2 days a month. Right. So the problem is, what I think a lot of founders are doing is they don't invest enough at the beginning. Then they get to a size and they go and get a CFO thinking the CFO is going to save everything. But actually, what they then do is they take their eye off the ball completely because they think the CFO is steering it. And the CFO will only still know as much as they're given in the terms of information. Right. And then it can get even worse because they say, so, I do just think an owner needs a level of financial literacy where they can ask questions, where they can basically challenge, because, obviously they use experts to pull everything together. But I've seen accounts where we've been given it and there's a 7 million liability in payroll on the balance sheet. And I would hope that an owner would be able to see that and go, why do I owe £7 million? Now, I'm not saying the owner should fix it because they wouldn't know the history of the transactions. But if that is what I call financial literacy. Financial literacy is being able to look at your top level numbers on your and spot, that doesn't seem right. What's my debtor and creditor days, and have financial ratio trends where when they're getting the trends, they can then analyze the movements. So that's why they then need someone good at financial modeling, because someone needs to give them that information, because it's unlikely they're going to be able to go away and start building all of their financial ratios on their own.
Right. Yeah. I mean, I sometimes use the analogy of like, when you learn to fly a plane, you typically learn through visual flight rules, meaning that like you learn to like get your plane up in the air, but there's very limited instrumentation. Most of it is by sight. And that's what a lot of founders, when they started very rudimentary, managing their business. But as you fly into higher altitudes, and as you advance as a pilot, you then need to go into instrumentation, which is like we were saying, when it comes to a business owner, knowing your financial ratios, knowing your KPIs, benchmarking against competition, understanding what your 3-5 year plan looks like, and really, embracing all of those aspects, whether it's directly through, managing it themselves or collaborating closely with a CFO. But unless you can get there, you really can't extricate yourself from the business. So then you have key man risk when it comes to a transaction, and your numbers are likely garbage. And what you were just describing about, an out of date balance sheet with like ridiculous numbers on it, that just happened to me in this transportation deal that we were talking about. And, because they had like different systems flowing into the balance sheet that were on a cash basis, but yet, everything was out of whack. And so there was a significant amount of time and due diligence that had to be spent in getting everything on the same accrual basis, and then cleaning up the balance sheet so that the acquirer knew exactly what they were buying when they bought the company.
And is this the bus company that we were talking about? So is it still ongoing now?
No.
Give it a bit of background so people know, because this was quite an interesting deal, wasn't it?
Yes, it was. And some of it is still confidential, so I'll keep a little bit of it, under wraps. But it was in my area, the Boston area. It was a legacy company. They literally started a bus company as soon as buses were invented and children started getting bused to school. So it was school bus as well as charter bus and luxury buses for events and things like that. It certainly grew and blossomed over 4 generations. And, it was a great company, but then the next generation was not interested in continuing the family legacy, which, sometimes that's a bit of a tipping point for a lot of business owner founders now, especially the baby boomer generation, is that they're finding late in the game that like their kids are saying, I really don't want to do this. Like, I don't want to do what you've done, mom or dad. I'd really rather not. So then they have been building and developing kind of an evolved lifestyle company, and now they have to go to market. So suddenly they have to sharpen up all of these things like the financial management, the team, all making sure that everything is in compliance, et cetera. So basically, it was a very strong EBITDA company. And it was acquired by, it was kind of ironic because the buyer, it was actually sold 3 times. So I had 3 different people come and have offers on the business. And we went back to market because the seller, just for whatever reason, decided that they didn't want to go through with the deal. And so it's been a long process with this family, but it was worth it in the end. The last buyer, and the one who actually closed on the business, presented as if they were an independent buyer at first with like some family backing and investors. And it turns out that they were actually backed by a private equity group. And the private equity group was calling all the shots on the purchase, which in the end ended up being fine because the business was very good. They were able to get things to the level that the private equity group was comfortable with them. But we did end up going through laborious diligence to get the deal done.
Yeah. And I find the thing I see with profits, because I do think as well, if people are thinking about selling, they can find ways to maybe inflate the profits, thinking over a couple of years, maybe they'll get rid of salespeople and things like this and they'll drop overheads. But the thing that people need to, the thing that I see, generally, good trade profits doesn't necessarily mean the business is an asset, because what could be happening is the business is the profits actually need to be like 10 points higher, so 10% higher, to then actually account for all of the staff they need. So, and that could include the owner's salary or things like that, because you tend to find in some of these, I've even seen businesses of, sort of bigger than 15 million going into the 20 millions, where they have hired like a managing director of form, or perhaps they've tried to do it through a sales director and the sales director is growing. But when you speak to that person, they're working 60, 70, 80 hours because they're just passionate about the company. But actually, if you look to the market and said, but if you were going to go and recruit that person again, if that would have been 2 roles for then you'd be doubling the salary for that level of hours. So their profits are high because they've got one person that happens to be quite committed to the company. But if you then looked at it at market commercially and put the real wages in for those hours of work, then instantly, that could be an 80, 90,000 pound drop, couldn't it? Sure. Instantly, just for one senior person.
Right. And also, we see adjustments when it comes to salaries adjusted to market. A lot of founders and closely held businesses will own their own real estate, and they'll be charging themselves a reduced amount of rent. So then they need to make an adjustment up to market rent. The other thing is, with a high capital intensive business, are they reinvesting in their capital? Like, do they have old equipment? Is it going to last the next umpteen years? Because if you're projecting a pro forma over the next 5 years and you have to account for net working capital to reinvest in capital that's going to be obsolete at some point in time. So there are a lot of tricks. And I think that's why it's important to work with advisors that know how to help guide you through those things.
And I've seen it. I've seen businesses where assets are over 700, where like they might have a warehouse or something over £750,000 on the balance sheet. And then you go and look at it and it's completely dilapidated.
Yeah.
So
certain industries, the equipment is not engineered for obsolescence. So certain industries, you can get away with that. Like, for instance, I sold a metal manufacturing company, and I guess, this old piece of equipment, which is like a huge behemoth in a piece of equipment, the newer models of it were not as good as like this old model. So, it's not always transparent, like where these tricks might be, because it's not just based on the age of the equipment, but it's also, what is the useful life? You might be able to buy something newer, but the useful life, because it's engineered for obsolescence, might be shorter. Maybe there's, software that isn't necessary, but it needs to be upgraded. There are so many complicating factors that can go into it, but it's just wise to be aware of these things and think about them as pieces to the entire whole.
And I think it also depends on who's buying it, because this is why people have to go, what's my business worth? It's only worth to whoever's buying it. So, for example, in that scenario, if you have a competitor that's coming to buy you that's already got all of the machinery that they need, the fact that your machinery might be completely dilapidated means that probably wouldn't change the value. If anything, you'll probably get more value because the business buying it knows that they don't need the equipment to buy that business. Whereas if you get sort of a first time buyer come in that doesn't already have all of the equipment, then obviously their expectation of the price is going to change because they're going to need more cash to get the equipment up to date. So I don't think there isn't really one set rule, I don't think, of who will buy or pay what for what business, because every buyer situation will be different.
Yeah. And I think that's also true why valuation is relative, because depending on who the buyer is, if you're a strategic buyer and, purchasing a company to be a roll up onto a larger platform or something like that, and you're able to reduce redundancies, the valuation should be reflected more positively than, say, someone who's buying the business as it is and it needs to operate as a single entity. Valuation is just a starting point is what I like to say. And then what I do as a banker and business broker is I will try to get as many competing bids on the business as possible so that we can then evaluate buyers based on not only the price that they're suggesting, but also, what is their overall kind of like vision for the business, and does it align with the founder or seller?
Yeah, because also, because I've seen deals where, people are buyers are buying that have got a group. So then sellers will try and adjust, perhaps say, well, you don't need the HR costs anymore. You don't need the accounting costs because you've already got them. I mean, I believe business should be bought on commercial basis of what it will. So obviously, yes, if a buyer's already got an insurance, group insurance policy and a group HR and a group finance, then probably they will get economies of scale through consolidation because that's just real life. I suppose the question then is who gets the benefit, because some buyers will be like, but why should I drop the valuation because they've done the hard work. But I think in the end it will just depend. I just see it depends on how much the buyer wants the business. Some buyers might choose to go halfway or just say, look, I'll give them the benefits because I'm going to reap those benefits back 5 times over anyway, even if they do it. And some are more strict and say, I don't want them to have any of the benefits. So I think it just depends really who's buying it.
Yeah. Yep. I mean, I totally agree. And that's why I think, having more than one competitive offer is important for the seller, because then they can see, how interested the buyer group is, what are they, how aggressively are they making their offers and that sort of thing.
Yeah. Oh, well, we're coming towards the end of the podcast now, but it'd be great just to hear about what you're working on at the minute and if people need help with you, Erin, where they can find you.
Sure. So you can definitely find me on LinkedIn, Erin O'Leary, MBA. I do a lot of LinkedIn, and I also like to connect people through LinkedIn. I'm interested in connecting with advisors as well as business owners, just to, again, try to democratize and demystify the process of selling a company, because I've been there myself. And projects that I'm working on right now, it's ironic. I'm selling a metal manufacturing company that it's already under agreement with a potential buyer, but it's similar to what we were just talking about. Some equipment is more obsolete and other equipment is perfectly good. So every deal has a little bit of hair on it. I look at, buying and selling businesses as a little bit of a treasure hunt. You can always find some aspect of a deal that is very interesting. And I love, working on those things and trying to help people both on the buy side and the sell side find positive, interactions and buy companies. Because I really think that into the coming years, I think alternative investments and private equity is going to be more and more the norm than the exception. And private capital markets are becoming more sophisticated and less risky in terms of, being able to value companies and understand cash flows. And that's what you're here for, Julie. And I really appreciate you.
Oh, thank you. And thanks so much for coming on. It's great to, see a woman in doing it well in M&A, and because I don't know what it's like in the US. In the UK, I mean, I've probably been involved with about 100 deals now. I'm probably seen even more than that, but, end to end. And I would say I think I've only ever seen, I don't think I've ever seen more than 2 women buyers. Not on my podcast, but in terms of the deals I've seen in the UK, I think. Yeah. And then when you look at the transactional team across the M&A space, I don't know, probably 5% are women, I would say, maybe, in what I see. So I don't really think about it day to day. But then when you speak to another woman doing what you're doing, I thought, it is nice to showcase and, show women, they can go into M&A and buy businesses as well.
Yes, absolutely. And I love seeing that as well, because they're coming out with statistics that women tend to make better CEOs. Women also tend to be better board leaders and things like that. And it's not like a competition between the genders. I think, though, that women tend to be really good at it, but they're also very risk adverse because they're typically taking care of, I was a single mom, you know what I mean? And it's not an easy path to go, because there is so much risk. But as we start to come up with ways of dampening the risk a little bit through education and just using advisors and people like that, then I would love to see more women out there really buying businesses and doing what I do, which I think is a blast. I love what I do.
Oh, yeah, definitely. So, thanks so much, Erin. And thanks to all the listeners of the Build and Exit. This is our first recording of 2025. So here's to a good year. If you love our episode, hit the subscribe button so more viewers can find the channel. And I look forward to seeing you again soon.